Every generation faces moments that redefine wealth. Most people don't see them until they've passed, but history shows they come like clockwork, once in a lifetime, when debt, money, and power all collide. We are living through one of those moments right now. The question is simple. Will you recognize it and act, or will you miss it and be left behind? When you look across history, you'll notice that the greatest fortunes have never been made by following the crowd. They've been made by those who were able to step back, see the larger cycles at work, and position themselves ahead of the turning points. Most people get trapped in the noise of the present. They chase what has already worked rather than what will work. That's why the majority ends up average at best, while a small minority captures life, changing wealth. We are at a historic turning point. Debt saturation, currency debasement, and geopolitical realignment have created one of the rarest investment environments in history. If you step back and study history, you'll see that economies and markets don't move in straight lines. They move in cycles. Long debt cycles, short business cycles, cycles of rising and declining empires, cycles of money and credit. Each time the world reaches the late stage of one of these cycles, there comes a breaking point. And it's at these points where opportunities and risks are the greatest. Most people live their lives focused only on what's happening around them today, so they don't recognize when a cycle has reached its extreme. They keep extrapolating the present into the future, and that's why they get blindsided. Right now, we are not just in the middle of a typical business cycle, downturn, or recovery. We are at the convergence of three massive forces: the peak of the long-term debt cycle, the weakening of fiat currencies through endless money printing, and the restructuring of the global order as geopolitical power shifts. These forces together create a perfect storm, and within that storm lies a once-in-a-lifetime investment environment. Debt saturation is the first piece of the puzzle. Governments, corporations, and households are more leveraged today than at any point in modern history. In the United States, debt-to-GDP ratios are at levels not seen since World War II, and globally, the mountain of debt has grown even larger. The problem is that servicing this debt becomes impossible when interest rates rise. Yet keeping rates artificially low stokes inflation and further erodes trust in money. Central banks are caught in an impossible dilemma. Either inflate the debt away or face a wave of defaults. In both cases, the existing system comes under enormous strain. The second force is currency debasement. To deal with crises, central banks and governments print extraordinary amounts of money. We saw this in the aftermath of 2008, again in 2020, and it continues today. But every time new money is created without a corresponding increase in productivity, the value of existing money declines. Over time, this weakens confidence in the currency itself. History is full of examples, from the Roman denarius being clipped and debased, to the German mark during Weimar hyperinflation, to more recent emerging market currency collapses. When trust in money goes, people seek alternatives. The third force is geopolitical realignment. We are watching a world where power is shifting from west to east, where alliances are fracturing, and where trade and reserve systems are being restructured. For decades, the U.S. dollar has been the unquestioned global reserve currency. But as nations diversify their reserves, trade in their own currencies, and accumulate hard assets like gold, the dominance of the dollar is being challenged. This is not a temporary political spat, it is a structural rebalancing of the world order, the kind that happens once every 75 to 100 years. Put all three of these forces together, and you have a moment in history that is extraordinarily rare. It's not a minor fluctuation. It's the kind of seismic shift that resets the financial system, reorders wealth, and creates the opportunity for certain investments to multiply in value many times over. These conditions don't come around often, maybe once in a lifetime, and the people who recognize them early and act decisively will end up on the right side of history. Most investors are still treating this environment as if it's business as usual. They're relying on conventional portfolios of stocks, bonds, and cash. But what they don't realize is that those assets are directly tied to the system that's under pressure. They're holding on to the very instruments that will lose the most value when the shift accelerates. Meanwhile, the few who can step back, see the bigger picture, and identify assets that benefit from these transitions. Scarce, real inflation resistant assets will not only preserve wealth but multiply it many times over. This is why I call it a historic turning point. The forces of debt, currency debasement, and geopolitical change are not small tremors. They are tectonic shifts. They are setting the stage for what could be the greatest wealth transfer in generations. And like all major shifts, it will punish those who ignore it and reward those who prepare for it. Trust in fiat currencies is breaking down just as in past cycles. Capital will flee to scarce, real assets that cannot be printed or manipulated. At the heart of every economy is trust. Trust in the currency, trust in institutions, trust that the promises made today will hold value tomorrow. When that trust begins to break down, the entire system wobbles. Throughout history, currencies have always been tested, and over long enough time frames, most have failed. This is not a matter of ideology. It is a matter of arithmetic and human behavior. Fiat currencies, by definition, are backed only by the credibility of the governments that issue them. They are not anchored to gold, silver, or any finite resource. Instead, they rely on the belief that the issuing authority will manage them responsibly. But here's the problem: when governments accumulate too much debt, and when the burden of that debt becomes unbearable, they almost always choose the easier path, printing more money. Printing money allows them to avoid default in the short run, but it guarantees debasement in the long run. Right now, that process is unfolding on a global scale. The United States, Europe, Japan, and many others have created trillions in new currency over the past 2 decades. At first, it seems painless. The money is injected into the system, markets rise, asset prices inflate, and people feel wealthier. But the hidden cost is that every unit of currency buys less and less. Inflation is not an accident. It is a predictable result of excess money creation. And once inflation starts to accelerate, something far more dangerous begins: a loss of trust. People start to realize that holding currency is a losing game. They begin to seek alternatives: hard assets, commodities, or currencies issued by nations with stronger balance sheets. History gives us countless examples. In ancient Rome, the denarius was gradually debased until it lost nearly all its silver content, causing citizens to hoard gold and trade in kind. In Weimar Germany, hyperinflation destroyed the mark, and those who had gold or foreign currency preserved their wealth while everyone else was ruined. In more recent times, Argentina, Zimbabwe, and Venezuela have shown us how quickly trust in money can vanish. The pattern is universal. Once the perception shifts, it's almost impossible to reverse. Once people believe that their money will buy less tomorrow, they rush to exchange it for anything of lasting value today. That rush drives up the price of scarce assets exponentially, creating windfall gains for those who positioned early. The same forces are now emerging in major economies. The dollar, euro, and yen are not collapsing overnight, but they are being slowly eroded by policies that demand ever more printing to sustain ever higher levels of debt. Savers and investors sense this erosion, even if they don't fully articulate it. They notice that their purchasing power is shrinking, that their savings buy less, that their retirement feels less secure. This creeping recognition is the early stage of a much larger reallocation of capital away from fiat currencies. So where does the capital go? It goes where it has always gone, into scarce, real assets that cannot be printed at will. Precious metals like gold and silver, productive land, energy resources, and increasingly new forms of digital scarcity such as blockchain-based assets. The common denominator is limited supply and resistance to manipulation. These assets don't depend on trust in a government or central bank. They derive value from their scarcity and utility. When the world begins to lose trust in fiat, the flow of capital into these assets is not gradual, it is explosive. That's why this moment is so critical. The transition is already beginning, but it is not yet recognized by the majority. Most people are still holding their wealth in bank deposits, bonds, and paper promises. But the tide is shifting, and when it fully turns, the move will be violent and swift. This is why trust in fiat currencies breaking down is not just an abstract concern. It is the single most powerful driver of the next great wealth transfer. It's the reason some investments will rise tenfold while others collapse. And once again, history is repeating itself. The only question is whether you'll be on the side of those who saw it coming. Scarce, inflation, resistant assets will 10x wealth precious metals, critical commodities, and select technologies tied to productivity shifts are positioned for exponential gains. When the system comes under pressure, the natural instinct for most investors is to cling to what's familiar: cash, government bonds, and broad stock indexes. But here's the truth. In environments like the one we are entering, those safe assets become the most dangerous. Cash gets destroyed by inflation. Bonds get crushed by rising yields and defaults. Even stocks, which are often touted as inflation hedges, can see their valuations contract when interest rates rise and margins shrink. So if conventional assets don't protect you, what does? The answer lies in scarcity. Assets that are limited in supply, that cannot be printed or conjured into existence, and that retain value regardless of what happens to paper currencies. These are the assets that don't just preserve purchasing power, but multiply it when the system resets. The first and most timeless of these is precious metals. Gold and silver have been money for thousands of years. They have no counterparty risk, no default risk, and no printing press that can create more of them at will. Their supply grows slowly and predictably, unlike fiat, which can be expanded infinitely. In times of monetary debasement, gold and silver have consistently protected and multiplied wealth. The 1970s are a textbook case. When the Bretton Woods system ended and the dollar was devalued, gold rose 20-fold within a decade, and silver went even higher. Those who had positioned early saw extraordinary gains, not because of speculation, but because the monetary system itself had changed. The second category is critical commodities: energy, food, and industrial metals. These are not luxuries, they are necessities. Every society depends on them, and every economy requires them to function. When inflation takes hold, and when supply chains are disrupted by geopolitical conflict or environmental stress, the value of these commodities soars. We've seen glimpses of this recently as energy prices spiked after geopolitical disruptions. Imagine that dynamic playing out on a larger, longer scale. Investors who own these scarce resources, or the companies that control them, will be positioned to benefit enormously. The third category, which is newer but equally powerful, is select technologies tied to productivity breakthroughs. Not every technology qualifies. Many are speculative bubbles. but some innovations fundamentally increase productivity and efficiency in ways that endure. Think of the rise of railroads in the 19th century, the spread of electricity in the early 20th, or the explosion of the internet in the 1990s. Each of these waves created fortunes for those who recognized them early. Today, areas like artificial intelligence, renewable energy infrastructure, and decentralized digital assets are reshaping the global economy. They will not all succeed, but those that do could deliver exponential returns, especially when coupled with the breakdown of the old system. What ties all of these categories together is scarcity and resilience. They are not promises on paper. They are real, tangible, and limited. And because they are limited, when demand surges in a crisis, their prices don't just rise. They explode. That is where the possibility of a 10x return comes in. It's not about small, incremental gains. It's about positioning in assets that will become the lifeboats of the next era. Assets everyone will scramble to own when trust in fiat and traditional investments collapses. Most investors will miss this. They will stay in cash, bonds, or index funds until it's too late. By the time they realize what's happening, the exponential gains will already have been captured. That's why positioning early matters. You don't want to be buying scarcity after the world has recognized it. You want to be accumulating it before. That's the essence of capturing a 10x opportunity. Timing is everything once the mainstream recognizes the shift. Most of the upside will already be gone. The opportunity window is small. One of the greatest mistakes investors make is assuming they have unlimited time. They think they'll act when the signals are clearer, when the trend is obvious, when the media headlines confirm it. But by the time that happens, the real gains are already behind them. Timing is everything, and in transitions as large as the one we are entering, the early mover advantage is enormous. Think of how wealth was built in past transitions. When the United States came off the gold standard in 1971, those who immediately understood what it meant for the dollar and for gold had the opportunity of a lifetime, but most didn't act. They waited for proof, for confirmation, for consensus. By the time the average investor piled in, gold had already surged many times higher. The latecomers still made money, but the life-changing 20x returns went to those who positioned early. The same was true during the rise of China and emerging markets in the early 2000s. The signs were the rapid industrialization, massive demand for commodities, and expanding middle class. Yet most Western investors ignored it until the boom was already halfway through. By then, the easy multiples were gone. This is how markets always work. The best opportunities look uncertain when they are real. They look risky, contrarian, even uncomfortable. That's why so few people seize them. But that discomfort is the price of admission for extraordinary returns. By the time the opportunity feels safe, it's no longer an opportunity. It's a crowded trade with limited upside. Today, we are at the front end of a massive transition out of fiat and into scarce assets. The signs are everywhere. Central banks buying gold at record levels, nations trading outside the dollar system, investors quietly diversifying into hard assets. But it is not yet mainstream. The average investor still believes their cash is safe in the bank, that their government bonds are risk-free, that the system will muddle through. This gap between perception and reality is the opportunity. The window is not infinite. Once inflation accelerates again, once currency volatility spikes, once headlines start screaming about the crisis of confidence, it will be too late. The rush into scarce assets will have begun, and prices will reprice rapidly. Those who are positioned before that moment will capture the 5x, 10x, even 20x gains. Those who wait will be left chasing at the top. This is why timing matters more than anything. It's not enough to be right. You must be early. And being early requires conviction. It requires looking past the noise of today and understanding the deeper forces at work. It requires acting before the majority does, while there is still doubt and skepticism. That's the moment of greatest reward. If you study history, you'll see this pattern again and again. Extraordinary wealth is created not by those who follow consensus, but by those who anticipate it. That's the position we are in right now. The mainstream will recognize this shift eventually, but by then, the once in a lifetime gains will already belong to those who had the courage to move first. It's about preservation and multiplication. This isn't just about profit, but about protecting purchasing power, surviving systemic shifts, and capturing life, changing wealth during a global transition. When people hear talk of a 10x opportunity, they often think only in terms of profit. But in reality, this is about something much deeper. It's about survival. It's about protecting the real value of your wealth in a world where the rules of the game are changing. And it's about positioning yourself not only to endure those changes, but to thrive in them. Money is not wealth. Money is just a claim on wealth. True wealth is productive assets, resources, and capabilities that retain value regardless of what form money takes. In times of stability, it's easy to forget that distinction. You can hold cash, you can hold bonds, and they seem safe. But when the system begins to strain, when currencies lose credibility, when governments overextend, when debt burdens become unsustainable, paper claims on wealth become worthless. Real wealth is what endures. That's why this is not just about making higher returns. It's about protecting your family's purchasing power, ensuring that the value of your savings doesn't evaporate, and safeguarding your independence in a world of uncertainty. During past crises, those who failed to protect their purchasing power lost everything, not because they made bad investments, but because they trusted in the wrong system. Retirees who held their life savings in Weimar marks, or in Argentine pesos, or in Venezuelan bolivars, saw lifetimes of work wiped out in months. By contrast, those who held scarce assets not only survived, but often came out wealthier on the other side. Multiplication of wealth is the second part of the equation. When the system transitions, prices of scarce assets don't just rise modestly, they reprice violently. A small allocation into the right assets at the right time can transform fortunes. That's how generational wealth is built. It's not through steady compounding alone, it's through seizing rare moments of asymmetric opportunity. What we face today is one of those moments. The convergence of debt, currency debasement, and geopolitical shifts is creating an environment where scarce assets will not only preserve value, but multiply it. This is not speculation. It is the logical outcome of the forces at work. The question is not whether it will happen, but how you choose to prepare. The key is mindset. Don't think like a speculator chasing short-term gains. Think like a steward of capital preparing for a storm. Build resilience into your portfolio. Own assets that will endure no matter what form money takes. Position in those rare opportunities where scarcity meets rising demand. And most importantly, act before the crowd does. If you do, you'll not only protect your purchasing power, you'll capture the upside of the transition. You'll be among the few who don't just survive the storm, but use it to multiply wealth and secure freedom for generations to come. That is the essence of this once-in-a-lifetime opportunity. We are standing at the edge of a transformation that comes only once in a lifetime. The forces of debt saturation, currency debasement, and shifting global power are converging to rewrite the rules of money and investing. Most will ignore the signals, clinging to assets that are destined to erode, and they will suffer for it. But for those with the perspective to see the cycles, the discipline to act early, and the courage to step away from the crowd, this is the rarest of moments. It is a chance not just to preserve wealth, but to multiply it many times over, to turn uncertainty into advantage, and to emerge from the storm stronger than ever. The window is narrow, but history is clear. Those who seize it will define the next era of wealth.